Is there more headroom then in the dollar and nominal bond yields, and at what point do they become problematic for us in emerging markets in Asia?
So, Sri, this is a critical issue because on one hand, inflation around the world with respect to food and fuel have been easing. That's great news for Asia. But broader inflation trend in the U.S. hasn't really waned. And as the U.S. keeps hiking interest rates, that, of course, has a profound implication for interest rates and capital flows in this part of the world. So the risk is that the central banks here are forced to hike rates more than they would want to because the rate differential becomes so large and capital outflows become so acute that it becomes problematic from a financial stability perspective. So to me, that's the risk right now. I mean, virtually all central banks in the region have started hiking. They have no desire to match the Fed. And then they want to lag the Fed because their domestic imperative is fundamentally different from the U.S. Their economies have not grown the way the U.S. economy has over the last 6 quarters. Their reopening dynamic is nascent. And as I said earlier, inflation issue itself is not as pressing as is in the West. But the emerging markets will unfortunately end up importing the stress from the U.S. markets because of the open capital accounts and the nature of interest rate differential.
And in terms of trade flows, how profound could a slowdown in export growth be, Taimur, given the stress in Europe, given the stress in China too?
Sri, even without the issues in Europe or China, or even for that matter in the U.S., we probably were going to look at a secular decline in trade momentum worldwide. It had a very good run in 2020 and 2021 around pandemic-related emergency trade flows. And some of that was going to wane anyway. Additionally, the electronic cycle itself was ripening to some extent, and particularly with respect to chip demand, we saw lower guidance starting in the second quarter of this year. And now we have additional whammies, to your point, slowdown in Europe, demand from there, slowdown in China, which is having a very chastening impact on bulk commodity prices. And now we have the likelihood of the U.S. Needing to slow and entertain significantly higher real rates, which in turn would be a big dampener for demand. So the export outlook is not looking that great, but we're not looking at a precipitous fall either. As I pointed out earlier, much of the world is in the nascent phase of the post-COVID recovery dynamic, and therefore there will be demand for certain goods and services which Asia will supply. As you know, regional tourism is booming right now, and some consumer products are still doing pretty well, maybe not the chip side of the business.